Hello everyone, my name is Taha Zia and I'm a performance management lecturer at Phoenix Financial Training, Dubai. So I'm going to be talking about target costing, which is one of the important chapters in the costing syllabus area A of performance management. The first area in target costing is differentiating it from the conventional or traditional costing. So if you look at traditional costing, that is when suppliers were quite dominant, competition levels were low, they would calculate their cost, add a markup and charge you a price, and the poor customer would end up paying this price. However, over time, with the emergence of e-commerce, more competition has increased. There's more choice available to consumers. Today, a consumer walks into a shop, looks at a product, scans the code, checks the price online, and starts bargaining with the seller. And this is exactly where target costing comes in. Target costing is market focused. It's customer putting first. So we start with identifying your market. So I'm going to give you an example of the world's #2 brand, Huawei. So how has Huawei gained some clout in this very competitive industry? Their target audience were all those people who were big time fans of the Apples and the Samsungs. They came up with similar phones at lower prices of the same quality, and that is how they defined that market. That is how they gained their market share. So the first step is you determine a selling price. Now this is not an easy step because you've got to go out in the market, try to grasp your customer, ask your customer, what are you willing to pay for this particular product? If there is competition in the market, you also try to assess what competitors are charging for a similar product. Then you deduct your desired profit margin from it, and then you arrive at your target cost. Target costing is actually nothing to do with costing, but it is to actually find out what is that desired level of cost at which a business should be operating. However, our actual costs may not match the desired costs, and this is where a cost gap arises. So the second type of question which you can get in your exams is the calculation of the cost gap, which is the difference between the actual cost and the target cost. The next aspect of this is how do you narrow this cost gap? And this is where value engineering and value analysis comes in. So this is where a seller tries to think, what are those activities which do not add value? For instance, a lot of smartphones these days have built-in artificial intelligence in it. This particular mobile phone here has got 40 megapixel cameras in it. This is more like a professional camera now. I don't have to buy a professional photographic camera. I can buy a cell phone which is a camera inside it, and that is as good as a professional camera. So that's how you define a market. But then there are certain aspects which I do not require. There are certain applications which I do not need. So Huawei tries to track that. Sellers are trying to track what do customers like, what do customers dislike. Things which you like, they try to improve on those areas, and those which you don't like, they try to make them redundant. So this is how companies are trying to add value to their audience. Towards the end, the last bit within target costing, the important area is what are the limitations of target costing. Now, in my example, I was talking about OEM, the original equipment manufacturer, a company like Huawei. However, what about companies like audit firms, like consultancies, like banks, which are in the service sector? With the manufacturing company, majority chunk of your cost is materials, and it's quite simple to control costs when it comes to materials. For example, I could look for alternate supplies, I could look for different suppliers, I could buy in bulk and get bulk discounts. But when it comes to services industries, it is very difficult to control costs because majority of the costs are people costs. And once you get appraisal and once your salary goes up, it's hard to bring it back down. And that's what John Maynard Keynes, a very famous economist, argues that wages are downward sticky. Once you increase them, you can't bring them back down. So that's the problem with the services sector. There are other limitations too, and you can remember them with the help of an acronym SHIP. So the S is simultaneity. So here I am delivering you a short lecture, and here you are listening to this lecture. So the production and the consumption of this service is simultaneous. Heterogeneity, when I do the same lecture in class, I don't speak this quick. I give different sort of examples. So depending on the type of audience I've got, I'm going to customize my offering there. Intangible. This service right now lacks the physical features. And the last point, perishability. But with the help of IT, we can store these videos now. However, there are certain services which are difficult to store and they have a very short shelf life. I hope you have enjoyed watching this video. If you have any questions, please feel free, and we here at ECCA Middle East will be happy to help you. Thank you for watching this video.